balance sheet. First, realize that every business has to borrow money. It's not born with any of its own, even if it is your business. You are going to have to lend it your or someone else's money. Let's start the balance sheet from a historical position. Scrooge would have laid out his balance sheet like this. Everything he borrowed was on the left. Everything he did with the money was on the right. Then he put long-term things at the top. Long-term borrowings on the left top and long-term use on the right top. At the bottom, he put short-term borrowings on the left and he put short-term use on the right. Using better words we have long-term liabilities, fixed assets, current liabilities, current assets. A more modern approach involves moving the current liabilities from the left to the right. When it lands on the right, it becomes a minus amount. But of course, current assets minus current liabilities is our old friend working capital. Let's have a look now at the long-term liabilities. What could they be? Money lent by the original owners, which could be share capital if it were a limited company. Money ploughed back each year from profits, called revenue reserve. Instead of spending your revenue, your income, on beer and fags, you put it in the business to make it grow, to say, buy a new vehicle. Debentures, which are secured long-term loans. Loans from others, which are not high-risk capital of the business. Now, across to the top right-hand side of the balance sheet, we have fixed assets. What could they be? Land and buildings, fixtures and fittings, plant and equipment, vehicles. And now we need to take a final look at all this together, a complete balance sheet. Remember Scrooge. The balance sheet always balances. Money borrowed must equal what you did with it. On the left, the long-term borrowings totaled 1,740,000. On the right, the uses are also £1,740,000. This is split up into fixed assets and Working capital.